As financial markets move deeper into algorithm-driven execution, 2026 has become a defining year for liquidity transformation. Traditional market-making models are being replaced by high-frequency AI-driven engines. New global regulations are forcing platforms to rethink how liquidity is sourced, aggregated, and delivered to traders. This shift is fundamentally rewriting one of the market's oldest mechanisms, price discovery. The algorithmic liquidity shift is not just another technological trend, it is a structural evolution. It affects every trader, whether retail or institutional. Over the past decade, liquidity has become increasingly fragmented. More exchanges and liquidity venues have emerged. Algorithmic market makers are replacing human decision making. We see rapid cross venue arbitrage and real time liquidity pullbacks during volatility. Increased regulatory pressure on high risk order types has also been a factor. By 2026, regulators in Canada, the EU, and Asia introduced new rules to increase transparency in algorithmic liquidity behavior. Instead of reducing risk, these rules expose just how dependent modern markets are on AI-driven liquidity engines. As a result, price discovery, once a simple function of buyers and sellers, now depends heavily on algorithmic routing, automated quoting, and cross-market execution logic. Modern liquidity engines operate at speeds no human could match. But speed alone isn't the breakthrough, it's the logic behind how orders are matched. Traditional order books showed static quotes. Today's quotes shift in milliseconds based on volatility indexes, cross-exchange spreads, HFT sentiment signals, and real-time order flow pressure. Price discovery is now a continuous adaptive mechanism. AI-driven liquidity pools quote tighter spreads during calm markets and withdraw depth instantly during volatility. They reroute orders to reduce risk exposure, creating price movements that look erratic but are actually systematic responses to risk. No single market determines the price anymore. Algorithms average prices across global exchanges, OTC liquidity, dark pools, and synthetic pricing feeds. The true price is now a composite signal, not a single number. In 2026, advanced liquidity engines use predictive modeling to anticipate upcoming liquidity shortages, spread widening, institutional order flow bursts, and arbitrage gaps. This predictive layer heavily affects price discovery, often before traders notice anything unusual. Regulators didn't intend to disrupt liquidity, but they did. New rules now require transparency in algorithmic decision logic, documentation of liquidity sourcing paths, runtime risk control frameworks, and audit trails for every execution event. These measures reduced hidden manipulation, but also triggered slower reactivation of liquidity after volatility, more visible spread expansions, stricter throttling during news events, and tighter margin requirements. The result? Price discovery in 2026 is cleaner, but also more reactive and algorithm dependent than ever. Faster but more aggressive spread behavior is now the norm. Spreads tighten instantly and widen even faster. Price wicks become algorithmic patterns where short spikes often reflect liquidity pullbacks, not market manipulation. Execution routing matters more than ever. The broker's technology determines whether your order is filled at the real market price. Transparency becomes a trust factor for traders. They now expect brokers to show where liquidity comes from, how orders are routed, and how AI systems behave during volatility. Without this transparency, traders assume the worst. The 2026 shift is only the beginning. By 2030, analysts expect 80% of global liquidity to be algorithmically managed. Cross-asset liquidity models will blend crypto, FX, and commodities. AI-driven prediction will be more influential than current bid-ask levels. Regulatory frameworks will require real-time AI oversight. Price discovery will evolve into a hybrid system where human traders react to market conditions, algorithms shape the conditions, regulators control the boundaries, and brokers serve as the bridge between all three. The algorithmic liquidity shift is redefining the foundations of modern trading. Price is no longer just a number derived from supply and demand, it's the output of complex adaptive systems operating across dozens of venues in real time. For traders, the priority in 2026 is clear. Choose brokers and platforms that understand this shift.